Welcome. In this video, Zbcn coin has a 400% increase opportunity. What is the reason? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand.
An uptrend in price is considered one of the strongest and most reliable structures in technical analysis. An uptrend shows that the price has been steadily making higher lows and higher highs over a certain period of time. This structure indicates that the market is strongly supported by buyers and that demand is dominating supply. The trend line, in particular, serves as a visual and mathematical representation of this rise and is drawn through the lowest points or troughs of the price movements. Every time the price approaches or touches this line, it tends to react and continue moving upward. This is why the phrase, "the price must not break this," is extremely critical, because when the trend line is broken, market psychology and price dynamics can undergo a profound change. Such a break often signals that buyers are weakening while sellers are gaining strength. Therefore, preserving the current trend is vital for the continuation of the positive scenario in the medium and long term. Maintaining an uptrend preserves a sense of security for investors. Especially during the trend, each time the price bounces from this line, it marks one of the most important buying opportunities. These touches show that the market still considers the trend line a strong support level. If the price moves away from this level and begins to climb again, it reaffirms the trend's strength. On the other hand, if the price falls below the trend line, the break can often trigger a new pricing process toward lower levels. This is why investors and traders pay very close attention to preserving the line in uptrends and often build their strategies around defending these critical levels. Preserving an uptrend is important not only technically, but also psychologically. Staying above the uptrend line reinforces the perception in the market that the buyers are still in control. This perception allows current investors to hold their positions and new investors to enter the market with confidence. This can lead to a chain reaction of additional buying, pushing prices toward new highs. As long as the trend line is not broken, the market's direction is considered upward, and the probability of continued price increases remains high. Therefore, each test of the trend line serves as a kind of exam measuring both the market's determination and investors' confidence in the line. In technical analysis, breaking an uptrend usually happens with a significant increase in volume. This is a sign that sellers are stepping in forcefully. However, if volume remains low when the price touches the trend line and the price quickly recovers, it indicates that the trend is still healthy. What matters is not just the touch, but the price's reaction afterward. When the price gains upward momentum after a strong reaction, it sends a clear "trend is continuing" message to market participants. This confidence created by this message can help the rise last longer and even steepen its slope. The situation is especially important for long-term investors. Long-term uptrends generally indicate that an asset is appreciating in a healthy manner. If the price maintains this trend, it signals to investors to stay in the position. As long as uptrends on monthly and weekly charts remain intact, the overall perception of a bull market persists. This keeps investor confidence in the market high. In the short term, an uptrend acts almost like a guide for traders. The trend line serves as a key reference point for setting stop-loss levels and making buy-sell decisions. As long as the price stays above this line, every pullback is seen as a new buying opportunity. Therefore, even in short-term trades, preserving the trend line plays a decisive role in the success of trading strategies. Additionally, preserving an uptrend creates a strong sense of momentum among market participants. Momentum refers to the tendency of the price to continue moving in a certain direction. If the price keeps making higher lows and higher highs during an uptrend, momentum is considered to be upward. This causes both technical indicators to produce positive signals and market psychology to lean bullish. This is why breaking the trend line can weaken not only the price's direction, but also the momentum. In conclusion, preserving an uptrend is one of the most critical factors for a market's health. As long as the price does not break this trend line, the likelihood of upward movements continuing is very high. Each touch becomes a test of buyers' determination, and passing these tests strongly lays the foundation for a long-term bullish story. For this reason, investors must pay attention to the technical levels necessary to prevent the price from breaking this trend, manage risk accordingly, and closely follow market developments. As long as the uptrend remains intact, the footsteps of the bull market grow louder, and investors can confidently take advantage of the upward potential. But we can't make decisions based solely on trends. Let's take a look at other metrics as well. Stay tuned. A bearish order block located just above the price represents a highly critical zone in terms of technical analysis. This area is a price level where strong selling pressure previously emerged, with large investors and institutional buyers, sellers, taking positions. A bearish order block acts like a wall that cuts off the price's upward momentum and pushes it back from a certain level. There are two important points here. First, the fact that this zone has pushed the price down in the past. Second, the fact that the price has touched this zone twice without being able to break through. This tells us that sellers are still active at this level and buyers are not yet strong enough to break this resistance zone. However, there is a well-known rule in technical analysis: the more a resistance zone is tested, the higher the probability it will break. This is because with each test, the sell orders in that zone are partially consumed and buyers' pressure relatively increases. The fact that the price has touched this order block twice actually suggests that the probability of a breakout on the third or fourth attempt increases. Each touch removes some of the pending sell orders in that area. This means that if the price tests this level once more and buyers remain strong, an upside breakout could occur this time. Such a breakout often triggers an aggressive upward wave because once the order block is broken, most of the sellers defending that zone lose their positions, which can create a short squeeze effect. In other words, traders holding short positions rush to buy to cover their losses, pushing the price even higher. Breaking a bearish order block holds great importance, not only technically but also psychologically. Many investors in the market track this level. Some of them immediately buy when the order block breaks, as this breakout is a strong sign that control has shifted from sellers to buyers. Others wait for a candle close confirming the breakout before taking a position. This collective movement further accelerates the upward momentum. In the cryptocurrency market in particular, it is common to see sharp moves in a short time after such breakouts. If the price breaks this bearish order block, a resistance turning into support scenario could occur from a technical perspective. In other words, the price first moves above the block, then possibly pulls back slightly to test this area, which then begins to act as support. In this case, the uptrend rests on a stronger foundation. Such a scenario is often considered a strong signal for medium and long-term buyers because the level that once pushed the price down has now become a barrier holding it up. Another factor to consider is time. Sometimes it can take weeks or even months for the price to break such an order block. However, as mentioned earlier, each new test weakens the seller's strength. Therefore, patient investors wait for the moment the price breaks the order block and act quickly when the opportunity arises. The key here is to avoid panic buying at the breakout moment and instead enter after confirmation. This is because, in some cases, the price briefly moves above the order block but then quickly falls back. These false breakouts can cause inexperienced traders to lose money. Breaking a bearish order block is often a sign of either a trend reversal or a strengthening of the existing trend. In particular, if such a breakout occurs in an instrument that has been in a long downtrend, it could signal the start of a new bull trend. For this reason, technical analysts monitor these levels very closely and shape their trading strategies around such breakouts. Furthermore, after this breakout, there are often fewer resistance levels ahead of the price, meaning it could reach target levels much faster. In conclusion, although the bearish order block located just above the price currently appears to be a major obstacle, breaking this level could reveal significant upward potential. The fact that it has been tested twice is a factor that increases the likelihood of a breakout. When the breakout occurs, it will create a scenario in which buyers are strengthened both technically and psychologically. A breakout supported by high volume could trigger a new upward wave in the market, potentially pushing the price to challenge previous highs. Therefore, closely monitoring whether this order block will be broken will play a decisive role in buy-sell decisions. The structure we are currently observing in the market is a clear example of a classic and very strong technical analysis pattern known as the cup formation. These types of patterns generally appear after a long consolidation period and present investors with strong upside potential. A cup formation is formed when the price gradually dips downward from a certain level, making a rounded bottom, and then recovers upward with a similar slope. During this process, the price moves as if it is tracing the inner surface of a bowl. In the decline phase, panic selling is gradually replaced by buyers starting to accumulate, leading the price to reach the bottom. Afterward, with market confidence restored, the recovery phase begins. The current price point is almost at the completion of the right side of the cup and very close to the breakout level. This is a very critical stage in technical terms because once the formation is complete, a target projection can be made, and this target often indicates a potential rise equal to the depth of the cup. When the depth is calculated here, it shows that proportionally, the price has approximately a 400% upside potential, which signals a significant opportunity in the market. It is also very important to understand how investor psychology evolves during the formation of such a pattern. In the initial decline stage, panic and pessimism dominate the market, investors close their positions, and the price falls. Then, at the bottom levels, long-term investors who believe the price is now very cheap begin buying. This slows the pace of the decline, and eventually the price reaches an equilibrium point. This bottom stage is the widest part of the formation and usually sees low trading volume. Over time, market news, fundamental analysis data, or technical levels rekindle investor interest, and the price starts to recover slowly. As the recovery gains momentum, more investors join in, and the price moves toward completing the right side of the cup. At this point, the breakout level becomes crucial because if this level is surpassed, the pattern target in technical analysis comes into play. The 400% target here is not just an imaginary figure, it is based on technical analysis calculations from the depth of the cup. The price difference between the cup's bottom point and the breakout point is added to the breakout level to find the target price. This target shows how strong the potential rise in the market can be. However, it is important to remember that this is a technical analysis projection and can vary depending on market conditions. Still, when similar past formations are examined, there are many examples where the price moved strongly toward the target after a breakout. This momentum is supported by both technical buyers and new investors who see the breakout as an opportunity. Trading volume usually increases noticeably at and after the breakout, which indicates that the rise is healthy and strong. In such a scenario, there are several critical points that investors should pay attention to. First, it is important to confirm whether the breakout has truly occurred. For this, the breakout needs to be supported by strong volume. A breakout without volume is often called a false breakout and carries the risk of the price returning inside the formation. Second, it is natural for the price to make a short-term pullback after the breakout. This pullback means that the new support level is being tested and is generally a healthy signal for the continuation of the rise. Third, the time to reach the target can vary. In some cases, the price reaches the target quickly, while in others, the rise is slower and more volatile. Looking at the current price action, we can see that all the structural features of the cup formation have formed quite clearly. The price recovered from a long-term decline by making a rounded bottom and then steadily rose to the breakout level. A close above this level would mean the formation is technically confirmed. If this happens, the 400% potential upside target would be technically valid. Such formations are considered more reliable, especially when they appear on long-term charts, daily, weekly, as they reflect the decisions and psychology of larger investor groups. For investors, this type of opportunity is rare, and if evaluated well, can yield significant profits. Of course, risk management is very important here. Even though the technical target is high, unexpected developments can always occur in the market. Therefore, investors who want to take a position after the breakout should set stop-loss levels and keep their risks under control. Otherwise, if the formation fails, losses could increase. However, the current outlook shows that if the breakout occurs, the market could face a strong wave of buying. A 400% rise of this magnitude will attract investors' attention and further increase demand. In summary, the current price structure presents a highly promising picture in terms of technical analysis. With the completion of the cup formation and the breakout, it is technically expected for the price to rise by the depth of the cup. In this case, the 400% upside potential presents an important opportunity for investors. Of course, for such technical targets to be reached, the breakout must be supported by strong volume, market conditions must be favorable, and investor confidence must be high. At the moment, most of these conditions seem to have been met, which strengthens the possibility that the price could see a significant rally in the upcoming period.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming.
Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.